Okay, so this next video lecture is still the continuation of our module number 6, just-in-time and backflash accounting. So I would just like to repeat the discussion about the accounting for just-in-time manufacturing transactions, because in our previous video lecture it seems that it's not very clear. Okay, so again, for accounting for just-in-time, this is done considering the purchase of raw materials. So under just-in-time, purchases of raw materials is just equal to the requirement for production, because production is equal also to the items being demanded or to be sold for the customers. Okay, so in this accounting, we will be using the account raw and in process, and then later on it will be transferred to cost of goods sold. For the direct labor and factory overhead, so we will be using conversion cost account to accumulate these costs. And then later on, it will also be transferred and adjusted to cost of goods sold account once the item is finished and or sold. So we have here the journal entries for traditional and just-in-time. So we will just be focusing on just-in-time because traditional accounting were already introduced. Okay, so you are familiar with this already. So you just take note of the difference between these entries. For the purchase of raw materials, so under the just-in-time, we used, instead of raw materials, we used raw and work in process. Okay, and then for the requisition of materials, there is no entry under the just-in-time accounting because this entry is already recorded right here. Okay, because we have here the work in process account. For labor cost, so again, as mentioned earlier, we will be using conversion cost instead of debiting it to work in process. The same with factory overhead as well, so we will accumulate it in the conversion cost account. For the factory overhead charge to production, so there is no entry yet under the just-in-time. For the completion of goods, so here we have here a note that finished goods is 20% of completed goods. So that's why this finished goods of 655, this is 20% of finished goods of 3,275. So this is the sum of the completed goods right here, which is composed of materials of 2,000, direct labor of 600, and conversion cost of 625. So this is 20%. Okay. For raw and work in process, we have here 1,425. So this comes from our raw and work materials that was debited right here is 3,000, whereas the completed goods for materials is only 2,000, so that is 1,000. For direct labor, the debited account right here is 800, and the completed goods is only 600, so the difference is 200. Again, this is placed here. And lastly, for conversion cost, we debited here 900, but the completed goods is charged for 625. So the difference of 275 is also debited in work in process. So this is what 1,425 comprised, okay, of those differences. And then cost of goods sold credit is just the balancing figure. So if you would notice, we credited right here cost of goods sold because under the just-in-time, later and it will be transferred. All the production, once completed, it will be transferred to cost of goods sold because what is produced is just equal to what will be sold. There is no ending inventory. Okay. And lastly, for the total production taken, so for traditional, 80% of finished goods is charged to cost of goods sold. So that's why in this case, 2,620 is just 80% of the finished goods of 3,275. Whereas for our just-in-time, we closed everything, meaning all of our raw materials of 3,000, conversion cost comprising of labor of 800 and factory overhead of 900, that's 17. So this is close to cost of goods sold because again, what is produced is equal to what is sold. There is no ending inventory. Okay, so we go now to backflash accounting. So for backflash accounting, this is when we wait, okay, for the items to be manufactured or completed before we can record all of the related issuances of the raw materials that were required for production. So this approach has an advantage of avoiding all manual assignments of cost to products during the different stages of production, and we can eliminate a larger number of transactions and also clerical labor as well. Backflash accounting is entirely automated, okay, and the computer is the one who is handling all of the transactions. For the number of raw materials units removed or requested from the storeroom, so to determine this, what we're going to do is to multiply the number of units produced with the unit count listed in the bill of materials for each component. So this is how to determine the number of raw materials that was requested or removed from the stock room. Okay, but in using Backflash accounting, there are certain problems that were faced. That's why Backflash accounting is not actually 100% implemented. Okay, later on, as we go along with our discussion, you will understand why. And this Backflash accounting is not also suitable for production which takes longer period of time, or for job order costing, because there is time lag before the transactions will be recorded, and for job order there is a specific bill of materials which is not practical. So that's why Backflash accounting is not practicable to use in those circumstances. So again, this is just applicable for those processes which makes the process simpler, okay, and this is not 100% applied to all production. So going back with the problem, okay, because of these problems, actually that's why Backflash accounting is not implemented 100%. So in Backflash accounting, it requires an accurate production count because the number of finished goods produced is the multiplier, okay, remember in our formula right here. So if this production count is inaccurate, then it will lead also into incorrect count, okay, for the raw materials from the stock. Another problem is it requires an accurate bill of materials. So again, if bill of materials is inaccurately itemized, then it will result also in incorrect number of raw materials taken from the storeroom. Third problem is it requires excellent scrap reporting because there will be inevitably unusual amounts of scrap or rework in a production process. So meaning we cannot do away from scrap or rework. So in just in time, these are not anticipated in a bill of materials. That's why if the entity will not separately delete these items, they will still remain in the inventory records, which should be eliminated. So since the Backflash equation does not account for them, so this is another problem. Fourth, it requires fast production cycle time, okay, because here we do not record the transactions until the items are completed. So that's why for Backflash accounting to be effective, it should be implemented in a production cycle which is shorter, okay. So when to use, okay, because when to use Backflash accounting, therefore, so because the cautious raised above, okay, so as mentioned earlier, we cannot implement 100% Backflash accounting. So only those circumstances where it is most likely to succeed. Okay, so that's why Backflash accounting can be incorporated only into a hybrid system in which multiple methods of production accounting may be used. So we have here the Backflash entries. So actually this was recorded per GIP, okay, if you could still remember. Okay, so we go now to the Backflash costing. Okay, so in Backflash costing, actually class, we use trigger points or prompt points, meaning in this case, we will wait for this happening to occur before we can record or account or recognize certain manufacturing costs. So in Backflash accounting, we have 4 variations. So it depends on the management on how they implement their GIP. So we have here 4 variations. The first variation is we will only recognize manufacturing cost at the time of the purchase of raw materials and at the time of the completion of goods. This is the first variation. Second is purchase also of raw materials and sale of goods. And then the third is only at the completion of goods, and fourth is only at the sale of goods. To understand better, so we have here an illustration. Okay, so we have here a GIT company. So they have the following transactions. They purchased raw materials for 160,000, placed all materials into production. They incurred direct labor of 25,000, actual overhead is 225, applied conversion cost of 235,000, which is composed of 25,000 direct labor and 210 applied overhead. So they completed all the work for the month, sold all the completed work, and then computed the difference between actual and applied factory overhead costs. So we have here, for requirement number 1, trigger points is raw materials and completion of goods. Second requirement, trigger point is sale of goods. Same requirement, meaning we have the first, purchase of raw materials and sale of goods is the trigger point, and then the third is only completion and or sale of goods. Okay, so for variation 1 is prompt or trigger point here is the purchase of raw materials and completion of goods. So this is our entry. Purchase of raw materials, so we debit raw materials and in process or work in process. Okay, credit to accounts payable. For issuance of materials, no entry, just like just in time, because it was already incorporated right here. For direct labor incurred, we will combine it with overhead, okay, in this next entry. So debit to conversion cost 250, credit to wages payable 25, and accounts payable of 225. Application of overhead, no entry. Completion of goods, so here this is the second trigger point. So we will debit the finished goods. So this is the total of our work in process and conversion cost already. Okay, and then at when the goods are sold, so this is our entry. Okay, we just transfer finished goods to cost of goods sold. And then for the variance, actually we have the same entry right here with the traditional, but we just used conversion cost instead of overhead control. So that is for variation 1. For requirement number 2, variation 2, purchase of raw materials and sale of goods. Actually, the entries from right here is the same, but we will just some differences basically, or specifically in transactions 6 and 7. So 6 and 7 is completion of goods and sold, or of goods, or goods are sold, So instead of having 2 entries, we will just have one entry for that. So the entry is debit to cost of goods sold 395, credit to raw materials and conversion cost. Okay, and for requirement number 3, this is for variation 3. Trigger point is completion of goods. So if our trigger points or prompt point is completion of goods, so therefore there is no entry for transaction 1, which pertains to the requisition or purchase of raw materials. And then the rest, we have the same entry except for transaction 6. Transaction 6 is this is the completion of goods already. So instead of the entry above, we will be using this one. So debit to finished goods inventory, and then we will close the accounts payable and conversion cost. Okay, so if you could notice, there is no entry for raw materials. We do not account for raw materials because that is not accounted for as a trigger point. So that is the problem in Backflash accounting. As mentioned earlier, they do not account for materials if this variation is used. For variation 4, is trigger point here is cost of or sold at the time the inventory is sold. So again, there is no entry for transaction 1. And then for transaction 6 and 7, this is transaction 6 is completion of goods, transaction 7 is sale of goods. So instead of having 2 entries, we will just have 1 entry. So debit to cost of goods sold, credit to accounts payable and conversion cost control. For factory overhead and direct labor, again, there is no related entry for raw materials because we have no entry for it. Okay, so that's for Backflash accounting. Usually Backflash accounting is being used for just-in-time accounting. But again, this is not implemented 100% because of the mentioned problems earlier.